Hello ladies and gentlemen, and welcome back. Well, so far so good for the thrust that we discussed last week, and that's been running through now to the key level. But guess what? We're ahead of the big information. Of course, inflation numbers and other big bits of news are coming. But on top of that, we also have over 100 years of economic data that we need to assess when we're talking about potential rebounds or a massive sell-off to come. We are in the worst month of the year for stocks, and of course this leads into every other market. But in today's video, we deep dive into bonds because they're telling us something a little bit scary right now. Well, welcome back everybody to the Daily Show where we talk about stocks, commodities, and cryptos. We've got a big video today because of course we're talking about everything to do with these markets. Once again, a quick shift from selling everything in terms of breadth to buying everything in terms of breadth. This has happened a few times now in 2022, and this was a very quick move here. The last time we saw such quickness was back in June, and what it led into was some weakness in the market after this reading. Again, back here in May into the start of June, we saw a very similar reading. It wasn't as quick to come back up, and then the market fell off. So what this is telling us again is that there's weakness or potential weakness coming from the stats. If we go back over almost 100 years of data, you'll notice that the last times that we saw this kind of appear, I mean, it has happened obviously during here in 1933, it's happened here all the way up until 2022 where we saw another reading. We often go into what we call a kangaroo style market, or at least some period of weakness. That next 1 to 2 weeks, timing well with, of course, our seasonality here on the markets, would be weakness. Now, 47% of the time, you've got to remember that's actually a pretty negative reading for the markets. When we get something like this, if you know your history with markets, 59% of the time markets are up. So when you're starting to see negative correlations with indicators, this is something we do pay attention to. So will this come true? Will the next kind of 1 month be shaky in the weakest month of the year? If it is, you still have to keep your mind open to the potential here of some big readings to the bull side over the next 12 months. And why do we say that? Well, investors are still buying. I don't know exactly who they are. Of course, it could be Wall Street. It could just be retail investors. But we saw a huge reading here, the second highest reading in terms of buying from the last 5 years and the 22nd highest reading since 1928. This is the 3-day average up issues ratio. You'll notice it hit a very, very quick number. The thrust here, the move in this market was very aggressive, and we do need to pay attention to that. If we go back over history, there's only been one single loss period since a reading like this has happened. And 12 months later, we have an incredibly good ratio and a very nice percentage return in terms of 17.1% on average over the next 12 months. So you must keep your mind open to this, even if you're bearish on the markets. You've just got to always think about this from a trader's perspective. And realistically, a trader doesn't really care on the direction of markets. What you're mostly interested in finding highly statistical areas to potentially place shorts or to potentially place buys in any market out there in the world. Speaking about finding high statistical areas, we don't want to be dumb money. Of course, at the moment, dumb money seems to be one of the bigger investors or buyers in this market, and smart money has slowed down as this market has come down recently. This is something that we always bring up and will continue to do so. Why is the market going up? A lot of people can't understand this. I would go and say straight away, it's got to do with this. Way too many puts. It was one of our big bull case scenarios that allowed us to get into the positive action in this market all the way back in the 3,900 area. So that was just too many puts were in the market. Last week, we saw 3 times more hedging than the extremes of 2008. That is massive. I mean, you can see here, look at that hedging. Look at the previous periods. Just absolutely phenomenal amounts of puts being entered into the market. Is that something we should be paying attention to? Absolutely. Is it something where the first couple of weeks, usually where retail sit, it may not go down? No, that's something you've got to keep open and optional, because the problem is too many people are too bearish in this market right now. Percentage of yield curves, what's going on there? Well, we're seeing basically recession-like signals. For anyone that's been watching or following the channel for a while, you'll know exactly what I'm talking about. 50% of all yields inverted, very good reading. 100% of the time since the 1970s, it's correctly called a US recession. And that brings us into some of our case scenarios. Of course, one of the big bull case scenarios is a double dip. That is, we keep coming down a little bit more. Maybe we get back into the 3750s, that kind of area, and then potentially move towards the bull case. You've got to keep an open mind to it, and of course, potentially have a system built around that concept if you're an investor. But for the bears, what you're looking for is a new low. Back down to those 3600s, a new low, and then we could get something seriously diabolical. A lot of the correlated periods back in history, 1973 and 2008, they're the most correlated to this current market. They're showing that there is some serious weakness, especially if a recession was to come. And we don't even know what a recession is anymore, thanks to the governments around the world. But realistically, that is something the bond market is predicting. Sickness in the US economy over the next year to 2 years. Let's move over to the S&P 500 during this time of year. Is it doing anything that we wouldn't expect? The answer is no. We're almost at the middle of September. Now, if you look at previous middle of September periods, we often tend to see that kind of bullish or sideways action, and then we see the drop off more into the later part of the month, into the start of October. So this is something that a lot of people, and we have included this, have been talking about. Is September coming later as per usual? This is data back from the 1930s all the way to now. So it's pretty accurate, and it's been, correlated for a long period of time. Yes, September is the worst month of the year on history. A lot of people know that, sure. But of course, the middle of September is really where we see the weakness. And why is that? The big options expiration. Remember, this week is quadruple witching hour. I'm throwing all sorts of terms today in this video. We'll be coming at you with a whole bunch of videos later on this week leading up to quadruple witching, because you have to subscribe for this. Quadruple witching is the hugest, biggest part of the market. It happens every quarter, and it's when all the big options expire. You'll see why it's so important later on today in this video. The losing streak ending. So if the stock market is going to go bullish, what's one of the big indicators people use? Basically, going above the 200-day moving average. If you notice, when we get these signal dates, they're not often wrong. Yes, we've had one back in the early 2000s, but most of them, even the one coming out of the GFC and the other ones over here, if you were always to go with one indicator, yeah, it's super basic, but it seems to work quite well. And this is taken since the 1950s, something to keep in the back of your mind. Well, let's get into the charts. We'll start off here with the VIX. It's doing absolutely nothing. 24 for the VIX. It's neither 35 nor is it 20. If you've been watching for a while, you'll know that they're the two levels we really look at. Max fear, or at least a high level of fear, and a high level of greed. And we're in the middle, so not really easy to read that. Let's get into the interesting stuff now, though. Yields, 3.57. I can't believe that the 2-year is already this high. What this is telling us is that inflation is expected to be sticky by the market. The market's expecting to have the yields at a higher rate for longer, because the 2-year is now very, very high at 3.57. We also know that the big problem with this is that it's where that yield goes to. So if I'm going to go down here and I'll show you where the April yield is, we've got a 4 handle on April yield, over 4%. So yield is going up and the stock market is going up. Does that remind us of certain periods of time? April this year wasn't good for the market, yeah? This is what happened. We saw that yield rise. At the same time, we go over to bonds. Here is high yield corporate bonds, HYG. And this is a big important one, because while yes, yields are going up and you could say, well, that's suppressing bonds. At the same time, take a look at this. Look at these series of lower peaks, okay? We've got lower peaks coming through here. And remember, a lot of these forward yield bonds were already quite high at previous times. So we've got a series of lower highs coming through. Let's do a comparison now to the S&P 500 and have a look at both of them side by side. We've got a series of course, random highs and things like that from the S&P 500. It made a lower high here. Then we had a higher high with a lower high on the high yield bonds. And at the moment, the recovery in the high yield bonds is not as strong as the recovery in the stock market. Who would you trust? Would you trust the big bonds traders, the one that trade risk and debt? Or would we trust the stock market that's known to be trapping to do with options? You've got to keep an open mind to this, and something that we'll be definitely following along with. Bonds do count in this current market. US dollar, let's take a look at that. It's weakened. And a lot of people wouldn't have expected this. Around this point here, everyone was writing articles. The easiest trade in the world right now is buying the US dollar. And I don't disagree that the US dollar is very strong. But at the same time, when everyone's writing about it, that's not the time that you should be getting into the US dollar. The US dollar strength has been here for months and months and months. So how do we look at this now? Well, we've got a breach of the high, and we've seen kind of like a little head and shoulders up here. You can see the left shoulder, the head, and the right shoulder, the break of the neckline, and it's so far so good. It's come down to where you would expect it to find a bounce, and the euro US dollar will definitely help us to figure this out. But basically, if you take a look at it, this is where you expect buyers to come back in for the US dollar. If it weakens and comes underneath this zone, I believe rallies will be met by sell. And that's what's going to be important here. Does the US dollar actually start to weaken? A massive critical zone for it right now. And if you look at something like the euro, we'll load up Euro USD here, click over, you'll notice it just hit a pretty important little level of structure and rejected it. So yeah, we get a new high, pay attention to weakness in the US dollar from that point on. At this point though, it's right on support, and of course the euro is right on resistance. Move over to gold. Similar story here. Gold has found very nice support. We talked about this under 1700 zone, or around this 1700, 1710-ish area. We're now at 1725. We are kind of bullish here on gold over the medium term. That is the next kind of 3 to 6 months. And a lot of that's got to do with what happens with yield. If the interest rates actually do drop, we'd probably expect gold to actually do relatively well from that. Don't ask me right now in the video why. Maybe if you subscribe, we'll go over it in the future. But yes, gold is kind of finding base. We kind of expect levels underneath here to potentially find some form of support. Levels like 1713, 1712, the 1705 zone, and of course this big one down here at 1692. These levels all should be relatively good support. And if we want gold to break out heavily, what we're looking for is we're going back over to the daily to put it in context, and we're saying, can we get above 1746? If we do that, pullback should be met by buy demand. And that's what we're looking for here on gold. We want to see a little bit more strength to really prove that it's starting to form an overall very strong base kind of structure, with, of course, huge investors hopefully coming back into it. US oil's pretty tough weekly here, of course, on support. As we saw, we go down to the daily. It had a decent session. It's kind of at resistance right now. I don't know how to feel about oil. I would say still down is the overall trend, but tradability, edge. I don't think there's that much edge in this market right now. There's a lot of geopolitical tension, a lot of stuff going on, obviously, with Russia, the Ukraine, all of those types of things. So I would probably caution against that on the shorter time frame at this stage. Let's move over to Tesla. Now, Tesla's doing really well, but one thing, it's leaving gaps behind. And this is something that we'll be talking about when we go through the stock market in just a few moments. So Tesla's coming up to a big resistance. And this is going to be pivotal because the stock market's also coming up to a huge level. 310 for Tesla, around this level to 316 is going to be what you would call the danger zone for the buyers. Somewhere here is where you would expect the weakness to come back in for Tesla, and it's worthwhile boxing up that range. And of course, trading appropriately and having the right risk parameters. Apple is kind of similar. It just filled one of the gaps it left on the way down. That is now filled. Nice little rally here. It's left a big one behind. Will it come back down and fill it? Well, if you watched the start of the video, you would know that we were talking about one of these lead indicators, a huge amount of thrust, or in terms of breadth movement. That breadth movement often was followed by sideways or weakness. And when we talk about one of the big key bits of like the interest rates, the inflation numbers that are coming out, that could cause that domino effect of weakness potentially moving forward as well. So we've got to keep an eye on that for Apple. Nasdaq is similar. Look at this area that we had late last week and early this week. We're getting closer to the target zone. Around that 12,850 zone was everything we targeted or what we wanted to see from the Nasdaq. So far, so good. What a rally. Anyone that got it, congratulations to you guys. Very nice move. And, it's been fairly significant. If we talk about it just from a percentage from the bottom, you're talking about 7% in only a few candles. That's very nice. So, of course, if you've been able to ride it down to this level, ride it back up, potentially get a little bit in here as well, or get even stopped out, you've had actually a very good month. The last month has been, I would say, relatively easy trading. Now, it may seem like it's hard on the surface, but it's been generally pretty good. Will we get this kind of magical zone finding the resistance again? Well, let's look at the SP 500 to try to get some more story from that. Previous structure highs over here left by June. Structure that was left in August. Structure that was again left into the beginning of, or just at the late end of August into the start of September. And this is where we really find the battle between the markets right now. This is the key zone. And if you load up things like volume profiles, you'll notice that they all show that 41.25 to 41.30 is a super important zone. And this is something that we really need to discuss because we've kind of thought about this for a while now. We've thought about this area and it's come from a few different zones. It's come from saying, okay, well, if we get a trend line, if we take the double bottom, we extrapolate that double bottom out, it gives us around that 41.50, 41.60 zone. 41.60 plus is that previous high. We're in the structure and this becomes the danger area for the bulls. If the bears are going to get control of this market, you would think they try to do it somewhere in here. Now you've got to keep an open mind to potentially going and filling gaps up here and then selling off. But this is the first area coming into the inflation numbers. Very, very important to pay attention to. Let's move over to the futures market. The futures market just tapped into the start of that box and it's now finding a little bit of resistance here in the futures market. It's really not going to count. What counts here is probably the inflation number. It could easily go bang, bang. It could obviously sell off here, or possibly even the inflation number could go really, really rally. But this is where patience pays off, guys. You've got to wait for the market to show that it's ready to turn around. Yes, key zone, absolutely tick. Do you believe the bears could come back in here? Yeah, you do. If you're a bull or you're a little bit scared around here. Fair, I would think yes, this would be a scary zone. So at this point, this is where you've got to have patience to be able to try to figure out how are you going to best trade around this kind of area. There's a lot of different methods. There's obviously options. There's, of course, CFDs. There's just taking shorts. There's all sorts of things. But you've got to practice a lot of risk management and patience in this zone. And that's usually what pays off from a good trader to a great trader. That's the big difference there. If we go over to options, why is this all happening? Well, it's got to do with this number here, total open interest amount. Almost 5 million. This is quadruple witching hour. This is the big one. Notice the max pain sitting at 405. Notice the stock price sitting at 411 right now for the SPY. If we scroll down here, you can see all of the options expirations. Notice also the calls, 430 and 420, starting to become more bullish here in the calls. So the market's doing a good job of starting to extract some bullish action from traders in this market. It's also got a massive put wall, you would think around 400 this week. So we're starting to get some pretty big numbers. These are all elevated numbers. It's the big option expiration. And then you'll have to look forward. So definitely subscribe because we'll be looking at the forward options moving forward into October to try to figure out where this market's really going to be allowed to potentially tank if it is going to do so, because the options really hold the key here. 411 again, current max pain 405 at the time recording, and it's quadruple witching. So expect usually the weakness happens on that Thursday if it's going to, because it's the day before the big options expiration. That's where that volatility starts to kick in. Bitcoin, so far so good for the bulls. It went pretty easily through this area here. I did think there would be a little bit more resistance at this zone. Didn't really act it, didn't actually trigger anything. So if you were patient, you would have done fine. And then now the market moves into the 23,000. Previous support structure, previous resistance. There's a chance that it gets this high back into somewhere around that 23,500, but they're all synergizing together. We've got US dollar at basically support. We have obviously got gold at a supportish level. We also have, of course, the stock market at a very nice kind of resistance high potential. Bitcoin going into that as well. All these markets are getting very, very close to critical levels. And guess what? It all happens ahead of the big bit of news. CPI and core CPI, 8:30 a.m. New York time, Tuesday, September 13th. Then we have more numbers, PPI, Wednesday, September 14th. And we scroll down and we have core retail sales coming out Thursday, September 15, 8:30 a.m. It's a big week of data, of course, also prelim UOM, consumer sentiment. Each day this week, we have a big bit of economic data coming out for the US. Expect the inflation number to be one of the bigger ones, and probably the retail sales could push these markets around as well. So because the Fed's data driven, it's all about the news. We're at the key levels. This is where we expect to be. And of course, you need to be paying attention. If you haven't already, come and join us on Twitter at FX Evolution handle. We post a whole bunch there. I'll be back from the honeymoon in only a few days. So I'll see you guys obviously on Twitter and in our Discord community as well. And if you're interested in joining our private Discord community, basically just click the links down in the description below. We've also got an exciting announcement. Our scalping masterclass course has been completed. So if you're interested in that, watch the channel because we've got a big one coming. And I've got to tell you guys, this is a very, very good course. I'll see you soon. Subscribe, like the video, and bye for now.